Hello traders, Gary Wagner here. Just about 11 o'clock in Honolulu, 4 o'clock in New York. It is Tuesday, November the 6th, 2016, and this is the Daily Report for Gold and Silver. We do have precious metals once again under pressure, once again at a critical junction or price point. Gold currently closing off about $5, $5.40 on the day at 11.71. Now it's traded to a low of 11.68 and change. And the high today was 11.77. So as you can see, we did get a quite contracted range on the day with absolutely the bias to the downside. Now, silver also trading lower on the day, down about 0.75%, about a 13-cent decline at 16.77. This, of course, is most active COMEX futures by way of a continuous contract. The low on today has been 16.74. And the high today has been 16.96. So we've had a little bit more of an expanded range in silver than we have in gold, but nonetheless, both are precariously sitting at a 61% retracement of the yearly range, and both are trading lower on the day. Now, one of the things that we can look at or cite as a primary reason or rationale behind this, of course, is dollar strength. Dollar continues to hold some real dominance, still trading above 100, although it has found resistance at 102, at 151, up about 0.4% on the day. And then, of course, the second thing that we'd want to look at, and we'll do that, of course, in more detail in trending markets, is the fact that we still have a risk-on environment with equities faring quite well. And a solid equities markets coupled with a strong U.S. dollar, and we are certainly seeing some strength today. This, of course, is our daily chart of the U.S. dollar. A couple of things of interest. We did talk about it in trending markets, but we've got a pretty interesting area that we're at. This lower dotted line here, of course, this represents our moving average. And when we look at it, it is a 28-day moving average. We also have our linear regression, so we're getting near the bottom of the channel. And then lastly, we have our Fibonacci retracement, which is highlighting a 23% retracement that comes in roughly at 99.68. And of course, we are at 99.98. So when you consider that we're just above the moving average, that we are just above a Fibonacci retracement level, 23%, and we are just above the lower end of this channel line, tells me that we could see a little bit more downside in the dollar, but I would look for a pretty swift recovery and also to have dollar strength move back up this channel, which brings us to our current chart in gold, bar chart, and it also has a simple fib retracement, the 61% fib retracement that I talked about in our opening letter. On one hand, we can make a case, and it is, I believe, a pretty weak case, that we could be forming some sort of a base in this area. This is a logical place to look for it. A 61% retracement, roughly at 1170, and of course that's the retracement of the yearly range from the yearly high to the yearly low, and that's how we arrive at this. But we have to be cognizant of a couple of things. First of all, on a technical basis, yes, we have consistently closed above this line over the last 3 weeks. Now, this being only Tuesday, we've got a ways to go, and we could slip below that. We've already had a low that is a lower low than last week. Last week's low is a lower low than the previous week, and this week 3 weeks ago has a lower low than the previous one, and that goes on for yet one more candle, which is the big drop that occurred just following the presidential election last month. So we are getting a series of lower lows. We can't really say that on any technical sense or study that we formed a base. What we can say is that we could be forming a base, and here's where it gets difficult, because a market that is consolidating before moving to the current market direction, meaning if a market is moving and trading higher, on many occasions that market will get to a certain point and then basically consolidate. In other words, trade sideways before returning to that particular direction. At the same time, you've got a market that goes up, and consolidation is showing you that you've reached either a top or a bottom. So in both occasions where you're consolidating before returning to the existing price direction, or when you've reached an actual pivot point in the market, both of those at the beginning have a very, very similar look. And so you can't determine whether or not this market's consolidating and forming a bottom or consolidating before moving lower until we substantially either pivot and move higher or break substantially below this price point. So these lower lows, while they bode to the bear side of the fence, we have not really broken solid below that. And more importantly, we haven't really seen follow-through selling during the occasions when the market has broken below there, because what we have seen is as the market tracks lower and reaches these new lows, support comes in, buying enters the market, and that's what's pushing the price back up. The second thing that really alludes to the fact that we could be consolidating is the fact that when we look at candle size, which is why I've gone ahead and converted the bar to a candlestick chart, we see that over the last 2 weeks, and again, this is only Tuesday, so anything can happen to this candle, but specifically last week and these 2 weeks prior to that, after this dynamic move down in which we saw so much value taken out of gold from a intra-week high of $13.40 to a low of $12.20, so $120 move in that 1 week in terms of the range from the high to the low. We've substantially reduced the range over these last couple of weeks. That also tells us that we could be getting in an exhaustion scenario where, quite frankly, the market is simply oversold. And then lastly, when we look at the Japanese average conversion of this same data, what we do see is as follows. We still absolutely, according to this chart, have a downtrend intact. That is by virtue that on a weekly basis, we have no wicks, upper wicks on these candles. At the same time, we have to acknowledge that body size has been decreasing week upon week. Now realize, these candles are drawn by taking the open. The open is actually the midpoint of the prior candle. So if you look at the open here, simply draw a line over, you'll see it matches up with the midpoint. So when you compare it to the midpoint of the prior candle, we've had a reduction in body size. We have had a market that has also sustained in terms of a closing basis above this critical level. And so we could see the market swing either way. On a fundamental basis, we still have a rationale for lower pricing. And so therefore, my bias is for that potential. But on a technical basis, we are seeing all the necessary signs of exhaustion of this current corrective sell-off. Time will tell, and we'll keep our eyes peeled because we will get an early indication of whether or not this market's going to break. And if it breaks, as I said, our next real target is really taking us down to what, about 1110, 1120, I believe, is our 78% retracement. So we've got quite a ways to go down if it does break hard. And if it finds support, well, then we've got an easy clip to 12 or 1220. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.